Q2 earnings season is officially upon us, and there is one company that I can pretty confidently say will be smoking the competition with their earnings report. Philip Morris International, or ticker symbol PM, is the maker of Zyn. And Zyn has been in such high demand recently that the company just announced they're building a brand new $600 million facility just to keep up with that demand. I believe this stock is undervalued. Many others do as well. And in this video, I want to talk about why I'm so bullish on Philip Morris going into this earnings report. I also want to jump into the chart so that we can add fuel to this fundamental fire and talk technicals, because technically speaking, Philip Morris is looking extremely promising as well leading into this report. And I want to talk to you about how high I think this thing can climb and the price targets I personally have in place in the case, big if, they do impress on earnings as hard as I expect them to. So that's the video, you guys. I hope you enjoy. Let me know in the comments below if you're a fan of Philip Morris or what you're really excited about this earnings season. If you want to know exactly how I'm personally trading Philip Morris through earnings, which call options I have on really every company, because I have about 10 stocks that I'm really excited about through earnings season, a lot of small caps in there as well. It's the first link in the description of this video. It's my complete portfolio, daily trade alerts, email newsletters. You get everything that this box here entails, and you can just pick whichever pricing plan you want. It's completely up to you. So if you do join, welcome to the winning team. Really excited for the days, weeks, and months ahead. It's been a hot month for us so far, and I'm excited for what the rest of July and August has in store. So again, if you join, welcome to the winning team. If not, no worries at all. Hope you enjoy this video right here. So speaking of the newsletters, I actually want to quickly read over just a couple of short paragraphs from the newsletter that I sent out right before standing up to record this video, and then we'll dive into these guys, okay? So I do want to discuss my thoughts about big tech too, because that plays into kind of these more value stocks as we approach earnings. So there will always be a mix of winners and losers throughout any earnings season. But as far as big tech is concerned, I still lean bearish. And go watch a few of my recent videos if you want to, if you're at all interested in why I feel that way. I actually think Tesla may have some room to impress. We'll see tomorrow at the time of recording. I'm recording this on Monday, July 22nd. But I think that names like Google, Apple, and definitely Nvidia remain too overvalued from a historical PE perspective. And speaking of historical PE's perspective, that actually pans into this article that we'll be reading as well. But more on that after we read over the rest of this right here. So if I'm correct, and if these multi-trillion-dollar companies fall short, then that won't only be good news for our put options, but for our calls as well. Investors are hungry. Capital wants to be invested. If cash begins to exit these overextended mega caps like Nvidia, it's going to begin looking for a new home in the more underappreciated areas of the market. I think we have quite a few undervalued gems in our hands, and I'm pumped to see what they can do in the days, weeks, and months ahead, as I was just saying. Okay, so again, you guys, if capital does flow out of these multi-trillion-dollar companies, Nvidia, Apple, $3 trillion a pop. Obviously, Microsoft, all the other ones, massive as well. Google announces tomorrow, multi-trillion-dollar company as well. If even a small percentage of capital flows from those companies into other companies, especially if you're talking small caps, it just doesn't take, like relatively speaking, it takes a lot less capital to appreciate the share price of a small cap stock than a mega cap stock. And that's just obvious math right there, but it's true. So really excited. I do think that poor big tech earnings, which Netflix kind of kicked off, is good news for stocks like Philip Morris and small caps. And yeah, I just wanted to let you guys know that, because that plays into a lot of other positions in the markets, probably a lot that you guys are excited about as well, not just PM. Okay, so again, if you guys want these newsletters, if you want my full portfolio, last time I'm plugging this, it's the first link in the description of this video. Let's get to reading this, and then we'll get to reading this. You know what? I think just because this one's a little on the longer side, we'll kick it off with this one because this is just objectively good news. We'll dive into the charts. I'll talk technicals, and then we can close it out for those of you who are interested in why this looks so undervalued, which I completely agree with this article. Okay, so and if you stand by this article, we'll see that my price targets are actually very, very generous. Okay, I should say very conservative, not necessarily generous. But okay, NBC. Zyn maker Philip Morris announced a $600 million facility to help produce the popular pouches in Colorado. The tobacco-free nicotine alternatives have been in short supply in the U.S. as a result of its runaway success. Zyn users rejoice. Production is about to ramp up in the U.S. Philip Morris, or PMI, Zyn's parent company, announced Tuesday it would invest $600 million to rebuild a production facility in Aurora, Colorado. I used to live right around there. Dedicated to manufacturing the popular nicotine pouches. Zyn has been subject to nationwide shortages as a result of its runaway success. PMI and its U.S. affiliates are accelerating their mission to move adults who smoke away from cigarettes in the U.S. by investing in new U.S. manufacturing capacity to meet the increasing demand for nicotine options that are scientifically substantiated as better alternatives. PMI America's president and CEO Stacey Kennedy said in a statement, "We believe Colorado is like-minded in its commitment to innovation, economic opportunity, and public health, and we are eager to work with the state and its talented workforce as we expand our U.S. manufacturing presence." Okay, so good news, you guys. Again, if you track Zyns, and I don't personally use Zyn, at least on a daily basis, I'll pop one in, once a month or something. But if you just keep an eye on it on the shelves, if you see it in your local gas stations, you probably notice that it's missing. I keep an eye on it because obviously I'm heavily invested in Philip Morris. Surprise, surprise. But there has been a shortage. And it's not because there's a lack of demand and they're just slowing down production. It's because there is so much freaking demand that they can't keep up. And that's obviously a good sign. Like, again, that it's obvious that if they're seeing increasing demand, it's good news. And again, this article should really kind of shed some light on how undervalued Philip Morris is. But right now, if they do impress on earnings, I want to talk quickly about why Philip Morris is just looking good from a short to medium term perspective as we approach earnings. And then, maybe after we finish this, we'll quickly jump back into the charts and I'll zoom out and we'll take a look at Philip Morris, taking a look at their recent all-time high in 2017 and just kind of comparing it to what we're seeing now. Okay, so short term, you can see that Philip Morris has been holding a very, very steady ascending channel, with this green line right here being the line of resistance on this channel, yellow line being the line of support, since their last earnings report in April, which we actually played over Waves Capital and made a lot of money doing it. So let's hope we can do it again. Philip Morris, in their last report, jumped over the course of about a week. I'm just saying the week of earnings, jumped about 10% in the week of earnings. Right now, we're actually selling off going into this earnings report. Not really selling off, but we're going sideways going into this earnings report because the NASDAQ bounced today. And again, this plays into why I think lackluster earnings out of big tech will be good news for PM, because it actually acts as almost a counter trade to growth stocks. Okay, so anyway, if Philip Morris impresses on earnings, I think that we could easily climb about 7% to my target of 1450. Okay, that is my first major profit target. And say they absolutely blow expectations out of the water, I wouldn't be surprised to see another 10% move up like we did in their previous earnings report. That would take us up 10% exactly to a price of $117.85. So 117.85 PM, which again, as we move into this article, would really not be that surprising at all. Okay, so if we scroll down here, you can see Philip Morris announces tomorrow. Let's go to the average analyst estimates. Always like seeing a strong buy from a technical perspective. That's just the cherry on top if I have an existing thesis in play. TradingView is the king of technical analytics. So if their algorithms feel like something's a buy, then the technicals, if they think it's a technical buy, it's probably a buy from a technical perspective. And then the fundamental fuel will just light that fire even further. Okay, so analyst rating is a buy. Let's move my fat head quick so we can see that. So the 1 year, the average price target, if we can see the forecast, I'll just click that and move myself back into the corner where I belong. You can see that the average forecast is at 112.87. A lot of strong buys here. There's really no one strong sell. It's probably, the guy's probably investing in like Altria or something, or a negating party. But you can see that their max price target is $134. And, that's also pretty conservative as well, with the max downside price target, who's probably the strong sell right here, still not being like super far below where we're sitting at now. But average, again, you never want to go for the far ends of any spectrum. The middle is usually the healthy place to be in. 112 does fall pretty nicely, 112, 113 with my price target of 114. And again, you guys, once again, keep in mind, Philip Morris has to smoke earnings in order for this to happen, okay? If they don't, if you're watching this and they haven't, then this is just all BS. But I'm trying to help you guys out before their earnings report. If you agree with this, obviously invest. I'm not telling you what to do, not telling you to do it. It's always your choice at the end of the day, but just know that my money is where my mouth is. I have plenty of call options on PM right now. Okay, so that being said, how high can this thing climb? If we really, really blow expectations out of the water, can we climb 40%? We'll see. So key insights using, first off, this is by Simply Wall Street, okay? And I really like this. I'll actually link this in the description of this video under the link to this puppy, just in case you guys want to check it out, because this is a very in-depth article, and I feel like this is useful information that we are not going to read over, but if you want to read over the rest, I'll link it below. Okay, so using the two-stage free cash flow to equity, Philip Morris International fair value estimate is $178. The current share price of 107 suggests Philip Morris International is potentially 40% undervalued. Our fair value estimate is 58% higher than the Philip Morris International's analyst price target of $112, as we just discussed. So today we'll run through one of the ways of estimating the intrinsic value of Philip Morris by taking the expected future cash flows and discounting them to their present value. One way to achieve this is by employing discounted cash flow model. Models like these may appear beyond the comprehension of the layperson, but they're fairly easy to follow. Remember though, that there are many ways to estimate a company's value, and a DCF is just one method. For those who are keen learners of equity analysis, the Simply Wall Street analysis model here may be something to interest you. So the method, we use what is known as a two-stage model, which simply means we have two different periods of growth rates for the company's free cash flows. Generally, the first stage is higher growth, and the second stage is a lower growth phase. To start off, we need to estimate the next 10 years of cash flows. Where possible, we use analyst estimates, but when these aren't available, we extrapolate the previous cash flows, or FCF, from the last estimate or reported value. We assume companies with shrinking free cash flows will slow their rate of shrinkage, and that companies with growing free cash flow will see their growth rate slow over this period. We do this to reflect that growth tends to slow more in the early years than it does the later years. Generally, we assume that a dollar today is more valuable than a dollar in the future, so we need to discount the sum of these future cash flows to arrive at a present value estimate. I know there's a lot of words, you guys, but again, that's why, and I'm reading kind of quick just because for the sake of your time. But I recommend you go in and read this and really try to digest it, because this is pretty important, and this applies to other stocks as well. I'd recommend going to Simply Wall Street and really looking up every stock that you're currently invested in or long on. Okay, so we'll just take a look at this quickly here and talk about this. Okay, so the total value is the sum of cash flows for the next 10 years plus the discounted terminal value, which results in the total equity value, which in this case is $276 billion. The last step is to then divide the equity value by the number of shares outstanding relative to the current share price of $107. The company appears quite good value at a 40% discount to where the stock price currently trades. Valuations are imprecise instruments, though, rather like a telescope, move a few degrees and end up in a different galaxy, so do keep this in mind. And again, you can see that we are currently about 20% undervalued. Even if we didn't climb to the middle of about right, or what they consider about right, if we just climbed 20% to where we're getting out of undervalued territory, let's take a look at this. If we climbed 20% from current levels, that would take us up to a new all-time high, which we're going to zoom out at now. 20% from current levels would take us up to about $129. Okay, so is that possible? Absolutely, especially considering Philip Morris is in a growth stage, okay? This is a legacy company that many people are like, this dividend is amazing. And that's actually what they showed. Where was it? They showed down, or that's what I liked. Where'd it go? Oh, right here. Well, yeah, dividend is in the top 25% dividend payers in the entire market. Like dividend, this is a great long-term investment. In my opinion, again, this is all my opinion. It's a solid stock. It's fairly safe. And again, for being viewed, in my opinion, as a legacy, kind of a boring company, slow growth company, Philip Morris is entering a new stage of almost hyper growth with Zyn, because it's such a revolutionary product. And I don't see this trend slowing down anytime soon. The beauty of nicotine is it's addicting. Okay? That's such a good argument for any stock. If something they're selling is literally addicting, it's going to be tough for them to slow that growth and break that trend. It's literally addicting. Okay? So that said, you guys, again, who knows how high this thing climbs? 20%, again, 10 to 20% is a general estimate for just looking at historic what happens in history, and if you're implementing kind of this fair value model. But we're gonna fall in the middle to my price target of 114.50. That's only 7% up from current levels. And even if that does happen, like even a 7% climb for this company would be amazing. And I do expect to see that prior to the month of August, in the week following earnings. And again, if they're real good, and if the forecast, if guidance is real strong, I wouldn't be surprised at all if to break to new all-time highs above $124 that we saw back in 2017. So that's the video, you guys. I hope you're excited. Let me know in the comments down below again what you're excited about this earnings season, and look forward to talking shop with you guys. Until next time, always remember, take action, make waves. Peace.